There is something strange happening at the top of the wealth ladder, and almost nobody talks about it. The richest people in the world, the ones with billions in stocks, real estate, and businesses, are borrowing money. Not because they need it, not because they are struggling, but because borrowing is one of the most powerful financial moves ever invented. While the average person saves up to buy something, the wealthy person borrows. While the average person sells their assets to raise cash, the wealthy person uses those assets as collateral and walks away with a loan. It looks strange on the surface. Why would someone worth $10 billion need a loan? But that question is exactly the wrong question to ask. The right question is this: why would someone worth $10 billion ever sell anything? Most people grow up with a simple idea about money. If you have it, you spend it. If you don't have it, you borrow it. That's the logic most people live by. When you need a car, you save up or take a small loan. When you need a house, you get a mortgage. When you need cash for an emergency, you might use a credit card. Borrowing, in the mind of most people, is something you do when you are short on money. It is a sign of need. It is a last resort. And for most people, debt feels like a weight, something to pay off as fast as possible, something to escape. So when people hear that billionaires borrow money, they assume it must be for the same reason. They must need liquidity. Maybe they are going through a rough patch. Maybe their assets are tied up somewhere, but that is not what is happening. Not even close. Here is where everything shifts. The wealthy do not borrow because they lack money. They borrow because selling costs them money. This is the part most people never learn. When a billionaire sells stock, that sale is a taxable event. In the United States, selling a long-term asset means paying capital gains tax. Depending on the amount, that can be anywhere from 15 to 23%, sometimes higher when state taxes are added. That means if someone sells $100 million worth of stock, they could immediately lose $20 million or more to the government. But if that same person borrows $100 million against that stock, no sale, no taxable event, no tax bill. They keep the stock. The stock keeps growing, and they spend the borrowed money. This is called buy, borrow, die. It is not a secret. It is not illegal. It is the way the financial system was built, and understanding it changes everything you thought you knew about wealth. To understand why this works, you need to understand one key idea. Assets and cash are not the same thing. Most people think of wealth as money sitting in a bank account, cash you can touch, spend, and use. But real wealth, the kind that compounds and grows over generations, lives in assets, stocks, real estate, business ownership, private equity. These things grow over time, and that growth is untaxed until you sell. So the game the wealthy play is simple: never sell. Instead, use the assets as collateral to borrow cash from a bank. Banks love this arrangement. A billionaire walks in and says, "I have $500 million in stock. Lend me $50 million against it." The bank sees almost zero risk. The collateral is worth 10 times the loan. If the borrower defaults, the bank simply takes the stock. So the bank offers an extremely low interest rate, sometimes 2 or 3%, sometimes less. The billionaire takes that $50 million, buys a yacht, funds a new company, pays for a mansion. Meanwhile, the stock keeps growing. If it grows at 7 or 8% per year, the growth on the remaining assets far outpaces the 2 or 3% interest on the loan. They are literally using borrowed money to get richer. And when the loan comes due, they borrow again, or they use dividends to pay it down slowly. The stock never gets sold, the taxes never get triggered, and when they die, the assets pass to their heirs at a stepped-up cost basis, meaning the capital gains tax that would have been owed on decades of growth essentially disappears. The system was not designed by accident. It was built this way. This is not theory. You can see it happening in public records. In 2021, it was revealed that Elon Musk had borrowed billions of dollars against his Tesla shares. At the time, he famously said he had almost no cash, but he had access to enormous amounts of borrowed capital. He used pledged shares as collateral for personal loans instead of selling stock and triggering a massive tax bill. The founder of Oracle, Larry Ellison, has used a similar strategy for years. Reports showed he borrowed against his Oracle stock to fund his personal lifestyle without ever needing to liquidate his core holdings. Between 2006 and 2018, Jeff Bezos paid almost nothing in federal income tax relative to the growth in his wealth. ProPublica reported that as his net worth worth grew by billions, his taxable income remained remarkably low. The mechanism was straightforward. Wealth held in Amazon stock, cash accessed through borrowing. No sale, no tax. These are not exceptions. This is standard practice at the highest levels of wealth. A 2021 ProPublica investigation using leaked IRS data found that the 25 wealthiest Americans paid an average true tax rate of just 3.4% between 2014 and 2018. Not 30%, not 20%, 3.4%. That number only makes sense when you understand the borrowing strategy. This strategy is not new. It has roots that go back centuries. The Medici of Florence built one of the most powerful dynasties in European history, not by holding cash, but by controlling assets and deploying other people's money. Their banking empire was built on the principle that wealth stays in assets, and liquidity is manufactured through credit. They never needed to liquidate their power base. They borrowed against it, extended it, and passed it on. John D. Rockefeller accumulated one of the greatest fortunes in American history. But what kept that fortune alive across generations was the family's discipline around never fully liquidating core holdings. Instead, the Rockefeller family used trusts, borrowing structures, and foundations to preserve wealth and access cash without triggering massive sales or tax events. The rich have always known something the middle class was never taught. Cash is the least efficient form of wealth. Assets that you never sell and borrow against are far more powerful. Now here is the part that explains why almost nobody outside the wealthy class does this. It is not about access. It is about psychology. Most people have a deep emotional relationship with debt. Debt feels dangerous. Debt feels shameful. Debt feels like losing control. And for most people in most situations, that feeling is correct. When you borrow to consume, to buy things that lose value, debt destroys wealth. A credit card balance at 20% interest on a television set is not the same as a 2% loan against appreciating stock. But the brain does not make that distinction easily. People avoid debt as a category. They lump all borrowing together as bad. The wealthy, however, are taught a different lesson from an early age. Not all debt is the same. Debt against depreciating assets is a trap. Debt against appreciating assets is a tool. This is the core financial psychology difference between how the middle class and the wealthy think about money. And it is almost never taught in schools. There is also a deeper psychological layer here. The wealthy have something called a long time horizon. They are not thinking about this year's cash needs. They are thinking about what their family will hold in 20, 30, 50 years. When you think that way, selling anything feels like a permanent mistake because every sale cuts the compounding chain. And compounding, given enough time, is the closest thing to a financial superpower that exists. Understanding this system matters, not just as an intellectual exercise. It has real consequences for how wealth is distributed across society. When assets are never sold, capital stays locked inside the ownership class. When capital gains taxes are never triggered, government tax revenues shrink. When inheritance passes with stepped-up basis, generational wealth transfers without taxation. The result is a system where wealth at the top compounds almost untouched, while people who earn wages pay income tax on every dollar. A teacher who earns $60,000 a year pays income tax on all of it. A billionaire whose net worth grows by $60 million in the same year because their stock went up pays nothing, because a stock going up is not a taxable event. Only selling is. Some economists argue this gap is one of the primary drivers of wealth inequality in modern economies. Others argue the system encourages investment and risk-taking, which creates jobs and economic growth. But what almost everyone agrees on is this: the rules are different depending on what kind of wealth you have. Wage income is taxed immediately. Asset income can be deferred indefinitely or escaped entirely. And borrowing sits in a category all its own: untaxed, unlimited, available only to those with enough assets to use as collateral. Here is the truth that most financial education never reaches. Wealth is not about how much money you make. It is about how little of your wealth you ever have to convert into taxable income. The wealthiest people in the world have solved a puzzle that most people never even know exists. They grow their assets. They borrow against them. They live on the borrowed cash. They never sell. And when they die, the tax bill that compounded over a lifetime disappears. This is not a loophole in the system. This is the system. And once you see it, you cannot unsee it. Now, can a regular person use this logic? In small ways, yes. Borrowing against a home, holding index funds for decades without selling, understanding the difference between debt that builds and debt that destroys. But the full version of this strategy, the borrow billions, pay almost nothing, pass it on version requires a starting point most people will never reach, which raises a question worth sitting with. If the rules of money work differently for people with assets than they do for people with wages, is the game designed to be won by everyone, or was it always designed to be won by the few who already hold the pieces? That is not a question with an easy answer, but it is a question you should be asking.